The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
Hi everyone, welcome back to the Multifamily Masterclass. I am Bart Diehl, the Director of Investor Relations at Neighborhood Ventures. Today I'm joined by two awesome guests, our Director of Finance, Heidi Butler, and our co-founder of Neighborhood Ventures, John Kobierowski.
You got it. Yep.
Got the last name right?
Yep.
Awesome. Today we have four exciting topics we're going to go over. The first topic we're going to discuss is the Fed rate cut that just happened. Then we're going to go over whether it's a good or bad time to invest right now. The third topic we'll discuss is whether baby boomers are stubborn or smart. And the fourth topic is Flagstaff the new Telluride? So we're going to jump into all that. But I'll dive directly into the first topic we're going to discuss, which is an article by Multi-Housing News titled Fed Issues First Rate Cut in 4 Years. So in the article, it says from March 2022 to July 2023, the Fed issued 11 rate increases. The Fed Reserve on September 18th announced a 50 basis point rate cut, likely the first of several. Multifamily experts have been expecting such a move, but some are on the fence about whether it's too little, too late to ease the stress in the multifamily market. With banks still hesitant to lend, thin margins on investments, and looming debt maturities, one cut might not be enough. Yet others are still very hopeful that this will improve market sentiment. So I have a few questions for you guys.
Sure.
I know in the past couple of years, transaction volume has been down comparatively.
Significantly.
Yep. But how do you guys anticipate this rate cut will impact multifamily investment opportunities?
For me, I was dancing last night. I mean, this is big. They dropped rates. They dropped it more than a quarter point, because a quarter point would have been a teaser. Mm-hmm. And I think what it would have done is given people hope without anything really to move the needle. So half point's good. I'm a little pessimistic on the comments that Jeremy Powell made, because usually they're not this much of a forward-speaking entity when they talk about stuff.
Yeah.
But to say that they're going to have another half point before the end of the year and then another point drop next year, I'm hoping that's just not to help supercharge the economy for benefits of political positioning right now. But I'll take the half point. What that's going to do, remember, that's money that the banks borrow from the Fed. It's not money we borrow. And it doesn't affect us directly. It's an indirect relationship. So the banks now pay 50 basis points or half a point less for the money they're borrowing. Hopefully at some point over the next few months that'll cycle through and we'll see banks start to lend us, the consumers, money at least at a half point less.
So do you think this will open up lending for banks?
I think it will open up liquidity. I think there are owners out there, whether you're a homeowner, you have a car loan, you have consumer credit, that you just couldn't refinance and restructure because rates were so high and because banks weren't offering any liquidity solutions. So I think that's what it's going to do. It's going to open up the opportunity for people to start restructuring their debt, pay off credit cards, refinance a car loan, refinance home loans, and other consumer credit out there, which is going to help move the economy a little bit more.
Yeah, I think it's going to be this kind of ripple effect that we see over time. So we're going to start seeing it through the banks. People, homeowners, apartment owners are going to start reevaluating what they have, what they've had locked up, deciding where they're going to go with it, what they're going to do. And then we'll just kind of see how the rest of the year plays out, if we drop another 50 basis points or not.
Yeah. Do you guys think this rate cut is enough to ease some stress in the market right now?
No. You got to put it in perspective. We went from 0% interest that banks were being charged for money to 5.5 was the range. Mm-hmm. So now we're down at 4 3/4-ish. Yeah. And we might be down a little bit lower than that if we keep going down. So it's not enough, but it's a signal that it started, and it's a fact that we haven't had a rate drop since 2016.
Yeah.
So forget about the fact we haven't raised rates. I mean, we've been raising rates. We haven't had a rate drop. So I think it's a good thing. I'm optimistic. The other thing is the Treasury bill. We just talked about this before we went on camera. Commercial loans are based on 10-year Treasury, for example. Didn't change.
Yeah.
It's fact it's gone up. It went up a little bit today, 3.7 today. So that's kind of weird. I thought that we'd see a little bit of reprieve in that, but I think it might take a little while. But it's a good move. If this stays on this track, if we see interest rates, we see fully indexed interest rates that we're charged for commercial loans in the 4s, even mid to high 4s, that's a healthy and safe place for us to be. And I think we can be there this time next year, but also within the first quarter of next year.
Yeah.
I'd love to hear your input on how you think this is going to affect our abilities, both from the opportunistic fund as well as just our regular individual projects, what this means for us looking for properties.
So that's a good point. Now, listen, there are owners out there that are in trouble that it doesn't matter that this rate dropped a bit. They're buried in operations. So they have payables that they can't catch up with. They have properties that have got deferred maintenance and down units, and they just can't get out of their own way. So even though you think this is a lifeline for some of those owners that are like, gosh, I need this, it might give them hope, but it doesn't save them because it's not going to happen fast enough. It's not going to flow through the system. So for us in the opportunistic fund, we're still on the same page. We're out there. In fact, I think it kind of presents an opportunity for arbitrage. That we know right now where we think rates are going to be in the next 60, 90, 180 days. So we can now make bets based on that. Obviously, they can change their mind, but we can make bets based on that, knowing that if we buy a property, do a bridge loan for the purchase and renovation, that we can refinance out at a number we know it's going to be. Because right now, we bought a property. The problem we've looked at is not enough sellers, the properties that have come to market haven't been the kind of assets we really wanted to buy. And probably the most important thing is we look at it and go, gosh, if we get a 2-year bridge loan, where are we going to be in 2 years?
Right.
Yep.
Well, now I can say with confidence, based on what was said yesterday in the Fed meeting, that we have an opportunity to restructure those loans in the next 6 months at a rate that's much lower than it is today. So that benefits us on both sides. So unfortunately, there are people that own properties and groups that own them. You just can't save them. You know, it's like what's the old saying? You know, it's like handing a dying guy a glass of water. You know, he's in the desert. It just doesn't matter. You hand him a glass of water. It didn't do anything.
John always has the best sayings. Well, while we're on the topic of the opportunistic fund, I do want to dive into the next thing, which is actually not an article. I know everyone that's listening to this podcast is used to us going over articles, but I wanted to touch on some LinkedIn commentary. So the CEO of Realty Mogul, her name's Jillian Hellman.
Sure.
She basically typed up some commentary on why investors are sitting on the sideline. And I'll read what she said. I've been involved in $1.2 billion of equity capital raises in my career, both operating capital and real estate capital. It has never been as hard as it is today to raise capital. Why is it that when it feels like the best time to invest, people are too afraid to jump back in the market? And then she says, I think it's all about emotions. So my first question I want to pose to you guys is, do you guys believe also it is one of the best times to invest? And the second is, why do we also believe right now that it's a difficult time to raise capital?
Well, I know Jillian, and she's smart.
Yeah.
And she's done a great job, and she's pivoted that company several times into a great organization. Unfortunately, we are herd animals. We move as a herd.
Yeah.
It's very difficult for one of us to break off and go in a different direction. And I think that's I've always been a bit of an individual, a contrarian, and kind of in my own personal life. So for me to be able to look at stuff like this today and wake up this morning and go, wow, rate cuts, cooler weather,
Things are looking up.
This election, I'm still not sure what's going to happen. I think that's probably the biggest uncertainty we're all grappling with. What's going to happen with the next? Are we going to have a change of administration or not? But in general, yeah, this might, we might be some of the charts that we see out there that I've seen on LinkedIn that we've talked about. We might be bouncing along that bottom, even though doesn't look anything like what it looked like in 2008.
Yeah.
I think emotion's definitely tied into this, and John probably can talk about this more than I can, but people are very emotionally tied to money. And when people feel more stressed about their money, the more anxious they are about every decision they make. When money's just flowing through the door, every decision's made with ease. And we've seen that a lot. And, we've hit an economy point where people are strapped for cash is kind of what I want to say, but not. People are feeling that tightness and no reprieve of what's going to come. Besides yesterday. Yesterday kind of shifted things a little bit about what could come. But with that tightness, people don't feel like just handing out their money or taking bets and gambles where they normally would. That risk factor, people feel much more apprehensive about. And since we haven't had a lift up until yesterday, I can see people pulling back their money. Their risk taste is very much gone away.
Yeah. My analogy is, if you touch a stove and it's too hot, it's likely that you're not going to touch a stove that's hot again. I've connected with some of our larger LP investors who have reached out to me about, hey, I need to invest in your fund because I'm getting capital calls from other operators saying they need more money to meet their debt service. So they want to invest in the opportunistic fund to make up for potential losses with other operators.
Sure.
So they're being burnt. They touch the stove and So there is an emotional base to it. There's fear.
Hey, and there are real losses out there.
Yeah.
I'm not going to mention companies because they're companies and people I know personally.
Yeah.
But there are a number of buildings that are going back in Arizona, in Texas, of course, and in places like Las Vegas and in Los Angeles right now with some large syndicators that bought a lot of properties. So you look at that; those LPs are going, we have money in these projects, and they're upside down. The rate caps are expiring, and it's hard to throw money into a deal that you're not sure is going to make it.
Yeah, and from our perspective, it's a great opportunity to go capitalize on those distressed, discounted deals.
Yeah, but we got to be very careful. And there's a couple that I wish we had bought already, but right now I'm gonna say I'm glad we passed on the ones we did. But there's a few other ones coming up that I feel a lot more comfortable right now making a purchase.
Great. Well, I want to pivot to our third topic of the day, and it's an article by Globe Street, and it's titled "Baby Boomers Refuse to Sell Homes as Younger Families House Hunt." So a snippet from the article is the majority of baby boomers who own many of the existing homes that could become the dream homes of young families have no interest in selling. And there was a survey done of over 1,000 baby boomers by Clever Real Estate, and it was conducted in July. And of the boomers surveyed, 54% of them plan to never sell. Only 15% expect to sell in the next 5 years. And 25% of boomer owners also want to stay put because a new home would cost more than they could afford as a result of inflation or because of the high costs associated with assisted living. So, John, I'm going to start with you. You've been active in the real estate market for your whole life. What advice would you give to a younger family looking to purchase a home right now?
Well, let me just look at the obvious. Inflation is still out there.
Yeah.
It might not be where it was before, but it's still out there. So things are going to cost more. Second thing, we have wage inflation, which of all the parts of things that are driving our costs, wages are definitely driving it. In fact, some of the other articles we've read recently, inflation in wages have gone up significantly higher than the increase of rent, fuel costs, anything else out there. So those things right there alone are going to drive the cost of new housing. And then land costs are not going to go down. So it's interesting to say that baby boomers, a certain percentage won't sell. Well, my experience is they might not sell, but when they have to make a decision that's not theirs, they are forced to make a decision, or a decision by default, the next generation will sell the home.
Yeah. Yeah.
So they might not want to sell, but the other reality is people don't want to sell at all right now because there was no reason to move out of one house to another in the interest environment we're in. The house is going to cost you more just to maintain if you had a loan on it.
Yeah, I feel bad for baby boomers, and if I put myself in their shoes, I can sell and have to go and probably have to pay a pretty significant tax liability because of the appreciation depending on how long you stay in the house. Mm-hmm. Or if you were to go buy something else after you sell, you're locking into an interest rate that's probably pretty high. So if I had to put myself in their shoes, I'm likely waiting, and this is morbid, to die to pass it on to my kids so there's a step up in basis. My kids can do what they want.
So you avoid the taxes, but
yeah.
And look, everybody I know that's the next generation up from me says, I'm going to keep this house forever.
Yep.
My parents say the same thing. But the reality is, like I said, the kids go, we're selling it as soon as they pass away. Like, I don't want to take care of that. I don't want to deal with it. So, there's a certain graying out of real estate that we're starting to see. This generation's created a ton of wealth. Mm-hmm. And the next generation is not about material items as much as they are freedom and options and being tied to a piece of real estate that their family was owned for a while, whether it's an apartment building, shopping center, even a house. There's a cost to them on their lifestyle to have to maintain that, and chances are they're probably just going to sell it.
So, if you guys had to guess, obviously we can't see into the future, but this massive transfer of wealth that's going to happen over the next 10 to 20 years, what do you think effect that plays in the real estate market?
I mean, it just gave me turnover, but unfortunately, for the younger generations, things are not going to be cheaper. So
Yeah.
that's really the whole bottom line. There'll be things available, but gosh, it takes two very strong incomes to be able to buy a house right now.
Yeah.
Heidi, I boxed you off from talking. Go ahead.
No, I think people look at the future generations are looking at everything as an investment. I mean, our access to investing portals, everything that we do, everything we look at is considered an investment. And, we bought our house, a duplex. It was an investment. That's why we made the purchase, not because we wanted a home, but we wanted passive income going forward. And I think we're going to see a lot of people renting their homes because they don't want to deal with the maintenance. They don't want to deal with anything. And they'll just put their money investing in other opportunities or in other assets, including real estate as an asset, but not as a home.
So the initial topic I posed was, do we think boomers are stubborn or smart? Stubborn because they're not selling, or smart because they're holding on until potentially their demise?
I don't think it's either. I think
Yeah.
I don't think they have an option. They can't. If they sell, they're going to end up with something less than they have, or something more expensive. And if they stay where they are, it's a default right now.
I agree with that. Great. Well, we'll transition to our fourth topic that we want to talk about, and it's something that I'm new to. I didn't know about it until right before this podcast. But we think Flagstaff might be becoming the new Telluride. Heidi, do you want to give some input on that?
No, I want John to start with
So I've always enjoyed Flagstaff.
Yeah.
I've talked about that before with our investors. I'm very happy with what we own. I own there personally, and we own as a company. But I've heard from a luxury real estate agent today about the number of high-end, what are they called, ultra wealthy celebrities that have been coming to Flagstaff now, and how that town is now just starting to hit the point where it's attractive. So Telluride, Jackson Hole, those kind of four seasonality places to live. It's got beautiful summers. It's got amazing winters that are not so bad that you can't enjoy it. The airport now accommodates full-size planes. What I mean by that is American Airlines now has a nonstop flight from Flagstaff to Dallas every day.
Wow.
I don't know how they fill that plane, but apparently it's full. So that's amazing that we're having flights coming out of the airport like that. And in my opinion, it's a relative bargain.
Yeah.
You're 7,500 feet, cool summer temperatures, plenty of water, which is another thing we always seem to talk about in Arizona.
Yeah.
And still land to build up there, and a town that has good health care, so several good hospitals, pretty good schools, and just a nice mountain town. I can see that continue to grow.
Yeah, I can imagine some nicer, even higher quality restaurants, things like that, coming into Flagstaff now that we're attracting a little bit higher end profile base. But, you look at places like Telluride, like Jackson Hole, you can't buy a lot of land right now. It's super expensive if you want to own anything there. Flagstaff's just at the beginning phase of that cycle.
Yeah.
Be a great time to get some land up there.
Yeah, this is prompted by that conversation I had, and I always felt that way, but now it's kind of interesting. We're seeing people that are bigger name, wealthy individuals and celebrities looking at it going, yeah, we get it. We understand. We could fly in, enjoy our place, spend time in town, go do other things, and then and either engage or not. But that feels, what's the other town in Idaho? Sun Valley, same thing.
Mm-hmm.
I mean, Sun Valley's just a little bit outside of good drive distance from a lot of other places, but it's got a great airport.
Yeah.
And it's attracted people for a while. So
Let me ask you, how do you think that affects NAU up there over the next 10, 15 years? If it becomes kind of a bigger, more touristy city, does that affect NAU in a positive or negative way?
it might cause some growth problems for them that they can't grow because the land's becoming more expensive or harder to grow. But I don't think that really becomes a positive or negative. I think it's going to be other things like the cost of home ownership up there.
Yep.
We've already heard pushback on the cost of living in Flagstaff is very high. We know we can't. Luckily, we have our own construction people that go up there from Phoenix and our maintenance people. But if you go to hire people up there to do work, it's very expensive, and because their cost of living is very expensive.
Right.
So I think that's what ends up happening in a town like that. Jackson Hole, most people can't own a home there.
No.
And there's not, also Jackson Hole, there's very small amount of private land in a center of a whole bunch of government land. So Flagstaff has got more of those options. But
Right.
yeah, I'm curious to see how that grows. The ski area in Flagstaff also, not massive, but decent. And every year they keep adding other lifts and they keep
Got some
expanding it.
potential to growth for sure.
Yeah, and then the summers are amazing. Again, 7,500 feet. This morning it was in the 40s there at night and 60s during the day. So
It's a great time.
yeah.
Yeah, I think it's fair to say if Flagstaff was a stock, we're putting our money in it.
Thank you for listening to our podcast, The Multifamily Masterclass. Please subscribe to get all of our new episodes.